Welcome to the SSI Orbit podcast, a forum for conversations that explore the ever-growing ecosystems of self-sovereign identity. And I'm your host, Mathieu Glaude. Today I sit down with James Loperfido, who currently serves as the Director of Business Development at the Swiss digital asset infrastructure company called Tangent. James also manages digital asset investments and acts as a general consultant in the blockchain space. He also serves as the co-chair for the Global Blockchain Business Council's Digital Identity Working Group. Now in this conversation, we start off by having James share his background of Wall Street and finance to set the tone for the conversation. We then get into the history of banking, what the different types of banking looks like today, and how banks are generally being threatened by Web3 and peer-to-peer networks. We do discuss some of the core efficiencies of blockchain networks and smart contracts. We then get into talking about CBDCs, central bank digital currencies, just understanding what they are, where the competition for central bank digital currency lies today, and again, how banks might get disintermediated by this. Now, once again, thank you very much for joining us here today. We're very fortunate to have you tuned in and listening to this conversation. Now, without any further ado, here is the podcast episode with James Loperfido. Enjoy.
Traditionally, I guess, focusing on technology in the States, you always had kind of this where people would show up to Silicon Valley, to the West Coast. There was a big community of people building cool stuff there, and you just had this ecosystem where people would feed off of each other and innovation would come out of there. But you always still had kind of this other side of things on the East Coast, notably on Wall Street in New York, where the purpose of Wall Street in New York was kind of to take these innovations and take it to the next level, take companies public, bring more money into it, and really put them into significant growth mode. And that kind of always was the way things were happening. And I think we could get into a discussion of how we see these things changing with Web3, and maybe throughout this conversation, that's maybe something we want to touch upon. But the reason I bring this up is because you have a background in Wall Street. That's where you kind of got started. I was thinking, for the purpose of this discussion, it might be interesting to set the tone, just describing kind of your knowledge in Wall Street and finance through your actual experiences.
Sure. Yeah. So I was super privileged in my teenage and college years to have varied exposure to kind of different elements of Wall Street just through internships that I was luckily afforded. And my interest in investing and trading generally came about from perspective of passion, for sure. But funnily enough, as a kid, I was always kind of like the fast kid running around and playing sports, and that was kind of my thing. And I was an adrenaline junkie, and I loved fast cars, even Tyco cars as a kid. And what I learned in New York was that the only people that could afford sports cars were traders on Wall Street. And so, having an entrepreneurial streak in me since I was 12 years old, building computers for older people when I figured out that you could, assemble the parts of a computer to build a working machine. I had this ambition of learning about trading and Wall Street because I had, family that was in the business, an older cousin that was a role model who worked in finance at a hedge fund and was a trader. And growing up playing travel basketball and a bunch of other sports, luckily one of the sponsors of my AAU basketball team when I was 12 years old was the president and CEO of the largest clearing firm at the NYMEX in New York. And he gave me an internship to learn the art of proprietary trading directly with him in a class of 20 kids from the age of 14 to 18 years old. And that experience was one of the most valuable that I had, opening up my eyes to capital markets and economics and generally how the world works, and really ignited my interest and passion for trading and investing and understanding the exchange of value in the world. And it just so happened that that year was the last year of open outcry pit trading in the pits, where oil and natural gas futures were traded face to face in a giant ring of crazy, aggressive type A, mostly men, screaming at each other to fulfill orders that would make, most people blush when they understood how much money was being transferred in a given minute. And it was one of the most valuable experiences, because I got to see in real time greed and fear expressed through capital markets and interactions in a way that is not really captured as easily nowadays, because technology has made markets so efficient. And so that was the first time through, experience in the realm of Wall Street where I observed technology replacing people and disintermediating brokers, and markets becoming more efficient, and spreads, broker spreads being reduced. And so that was the first time that I witnessed what technology would do from the standpoint of not necessarily eliminating people from many roles, but obviously it has done so. And it's something that I continued to observe. And ultimately that in some way led me to where I am today. But at each internship that I had, I was really lucky to have a front row seat to the subprime mortgage crisis in 2007 and 2008 on mortgage-backed trading desks at boutique investment banks, and one of the largest interdealer brokers at that time, probably still the largest, ICAP, where I really had a front row seat to things that were happening in the market that most people don't get exposure to at that age, and was lucky enough to study finance and economics in undergrad. And coupled with, the practical learning that I had with these internships and the books that these mentors that I had forced me to read when I was a kid, allowed me, I think, to start on a path of self-discovery and learning with that subject matter that I've carried with me, to my current time. And the first job that I had as a junior trader on a sell side agency only high yield and distressed bond desk for the 2 years after undergrad that I had, I saw that trend repeat itself, where spreads got thinner, people were being replaced by technology, and I kind of saw that writing on the wall. And that's kind of when I decided that moving toward tech startups and understanding what technology would do to the world would be a pretty smart idea. And to this day, over the past, I think 10 years, I think it's the number one most performant stock in the S&P 500 is a company called Market Access, which electronified voice bond brokerage. And so I watched this disintermediation happen, and now I'm seeing it in a different form through the application of DLT platforms, asymmetric cryptography, crypto networks, et cetera. So that's definitely been a theme. And the core of my education, I would say, has been the intersection of the development of capital markets and the technology as it evolves with them.
Now, you talk about having seen certain trends in the bond trading space and just on Wall Street in general, stuff like you mentioned, spreads getting smaller in transactions. So what are some of the inefficiencies that existed that have been eliminated, I guess, over the past 20 years through technology? And then what would be some of the maybe current existing inefficiencies that are still there that you think that are going to be the next ones to go with the use of blockchain, DLTs, identity technologies, and so forth?
It's harder to answer that second question. I think there's still some obviously room for improvement, but the financial system, at least in the United States, is very well organized, very efficient. Of course, has been susceptible to black swan events and, some things that are shocks and create systemic risk, right? Whether they were created through legislation, bad actors, combinations of the above, or what have you. But the more illiquid and esoteric securities trading is, typically the greater the reward for what would be a broker. In many cases, a sales trader or a broker on a desk like that is not just being compensated for matching a buyer and seller, but is also providing market intelligence, research, and all of the detail around a specific market to educate their counterparties or the asset managers or hedge funds or investment banking trading desks that they're essentially consulting to. And so I think smart contracts can potentially automate things a little bit further, reduce settlement issues and some back office and middle office functions in capital markets. Distressed debt, I would say, is probably one of the more esoteric securities that requires a lot of legal nuance and paperwork and approvals and compliance. But outside of that, KYC registration and figuring out how to essentially eliminate fraud and bad actors and money laundering from the banking system, which is obviously a huge conundrum given how much banks spend on compliance and generally how ineffective that has proven to be in terms of actually reducing money laundering and those types of harmful things that happen in markets and banking. But with respect to capital markets, I think, again, there are certainly efficiencies with respect to settlement and how interest is accounted for, and the automation with respect to escrowed transactions, I think could probably be made more efficient through tokenized assets and smart contracts to a degree. But I, of course, think there will always have to be some human oversight, especially with those more esoteric securities.
I've been interested in this topic for quite some time now, and you kind of touched upon kind of brokers bringing value into the system and maybe bringing more value when they're trading illiquid assets. There's also risk that they're taking in that transaction as well. But I've always been interested in using the ability to tokenize assets or create digitally native assets. I know we're seeing a big trend of that happening with digital art right now with NFTs, but more broadly speaking, I think the ability to tokenize assets does bring liquidity to the financial system. Is that something that you would tend to agree with, or how would you look at that, just kind of transforming some of these financial markets?
Yeah, it's a very deep question that has a lot of independent variables that can contribute to conclusions there. And I think obviously one of the biggest innovations is that tokenization allows for borderless transfer of assets without intermediaries. And can also embed data and have an audit trail, right, vis-a-vis triple book entry accounting. That is a feature of what we would consider generally an immutable network, like a DLT platform. And the interoperability presented by token standards will certainly allow for things that don't exist today. There's a lot that can be done there. And the most interesting thing is, I think, the ability to spread risk for high risk, large infrastructure style developments, such that you can match an individual retail investor's wants with a small amount of money and essentially de-risk large capital expenditures for R&D style projects, which was, I think, demonstrated partially by ICOs and to some degree did so in a successful way. And obviously there's all these pitfalls, right, with how things have transpired in that arena. But to me, the ability to solve supranational problems with a new risk model via global crowdsourcing presents a very interesting potential.
This is probably where we get into the conversation around the convergence of ID and payments as well. So if you're looking, this is a very, very interesting topic as well, being able to use this new infrastructure or these new underlying technologies to spread risk or maybe better manage risk, be more efficient about the whole thing. How do you look at how digital identity maybe plays a part here in this whole evolution?
Yeah, so it brings me back to another point that I neglected to mention answering your last question, which is that people with large size trades, what we call big lot trades on a trading desk, right? When they're making these trades, they don't want their activity or position or name to be affiliated with their activity, right? Because if $100 billion hedge fund shows their hand before they make a trade or unwind a position, then the rest of the market can react and negatively affect the outcome, right? So on Wall Street, there's a functional company, right, that essentially acts as what's called an interdealer broker that executes these large trades while providing anonymity to these two counterparties. And it's a very valuable position as a broker, and one of the few remaining where a human is largely responsible for executing these trades and crossing these trades. But what's interesting about that is we already have proof in the pudding with DEXs, decentralized exchanges, where you can have liquidity aggregated into a single platform with anonymous users, or at least pseudo-anonymous users, who can prove that they have this asset, lock it into a smart contract, and have it execute with a specific trigger, knowing that there's less counterparty risk, right? If, assuming, of course, the technology works and the smart contracts are flawless and everything works as according to plan, right? But that's where a decentralized identifier, or the ability to obfuscate the person behind an identity or the entity behind an identity on the internet, becomes very interesting, because now you can execute in a dark pool or a liquidity pool knowing that the systemic risk or the counterparty risk on an immediate trade is generally insured against. And that provides a very interesting idea, which these interdealer brokers and larger broker players that still exist are probably acutely aware of, because it's a very profitable business. And so that's where it gets really interesting is the idea that through zero knowledge proofs and asymmetric cryptography, you can obfuscate identity, but still know that that party has been KYC'd, has a certain type of financial standing or wherewithal, or assets to prove that a transaction should be executed upon. And being able to do so in a borderless, a global system with minimal friction and efficiency is something that will likely result from all of this innovation.
So I think just taking we've been talking very much on the use cases of where kind of some of the inefficiencies are in capital markets and how technologies that we're talking about here to do with digital identity or blockchain, DLT, just generalized Web3 technologies maybe could help eliminate risk and create more efficiencies. I think it would be valuable for myself, and I think for the audience, just to take a step back and just look at the banking sector as a whole. I'd be interested to hear your perspective and maybe give a bit of history on the business model of banks and banking and how they came about, to then kind of get into the part of where's the big money that the banks make today.
There's all different types of banks, right? And they vary wildly in function depending on regulation and their place in the world. One comparison would be Sharia compliant banking is completely different than what we have in the United States, right? Where in the United States, bulge bracket banks with large balance sheets dictate a lot of behavior, not just because they have the most assets, but because they can attract the best talent, provide the most research, move markets, influence opinion through the research that they provide to, not just institutional clients, but the growing segment of private wealth investors that have direct relationships with, essentially a wealth manager. But, there's different types of banks. There's consumer banks, there's investment banks, there's boutiques that focus on specific things. You have consumer banks where obviously their revenues are generated from lending, simple things like ATM fees, foreign transaction fees, wire fees. Then you have investment banks where revenue streams come from trading, issuing securities, underwriting debt. Those are obviously much larger institutions that work with, governments and the largest corporations. And there's certainly an art to underwriting and ensuring that markets are sound and that counterparty risk is minimal, and that a bank's investments, the asset management arm or the trading arms of a bank are monitoring the risk and executing according to not just their strategy, but what the market allows for. And so they have to innovate as much as the tech startups that are supplying innovations to the banks themselves are. And so how all of that unfolds is interesting because with respect to blockchain technology and frictionless payments that are enabled through these peer-to-peer payment networks that essentially allow for near zero value exchange in terms of transaction fees. Banks don't have a vested interest in reducing fees to zero. In fact, they probably want a slowly controlled race to zero in terms of transaction fees, right? And then you have other types of financial institutions like Western Union, who charge anywhere from 5 to 10% for remittances around the world, who make a ton of money doing that, which is obviously focused on cash. But at the end of the day, one of the interesting things about this is that despite the practical implementations with the innovation of blockchain and DLT networks, banks own a lot of the patents and intellectual property around it. And so a lot of people think that, banks are going to be easily disrupted, but the truth is that they have tremendous power, not just because of the, assets under management or their balance sheet, but the relationships that are forged between an investment banker and the company that they're providing services to. And so it's really interesting to think about how much will be automated and how much will maintain a required human touch. Because obviously there's something to be said for who you do business with. But this idea of trust replacing human relationships with automation and technology is something that is obviously going to be explored in depth through implementations of this technology and vertical.
It's interesting on the consumer bank side of things, where we talk about all the money that they make from different types of transaction fees, and it's quite funny seeing. It was probably like some quarterly results that were published from one of the big banks, and people were kind of outraged by the revenue that they made from all sorts of different types of fees. If it's like
their fees of like, I don't know what to call them, right? But like overdraft fees, ATM fees, foreign transaction fees, interchange fees on credit card transactions, which, although applied to merchants, essentially dictate or impact the price a consumer pays for a good, right? So the fact of the matter is Bitcoin has proven that it's possible to essentially almost do away with those fees, right? And DeFi is now the current environment where that is being thoroughly explored, not just from a payments perspective, but a peer-to-peer lending perspective as well, right? Which is not limited by much, especially when it can be done easily across borders now. So
yeah,
very, very interesting themes to explore there.
Yeah, I guess what happened with kind of computing in general and the advances in cloud computing just made it so cheap to send bits over kind of a network. So but basically all you're doing is updating fields on databases, which is basically the cost of that is zero. And so when you look at the fees that banks charge for, still today, I send a wire, I'm being charged $35 to send a wire, when literally they just need to be updating databases on it within different organizations there. So it's quite crazy. And then I guess on the investment side of things, I guess what we're seeing with crypto and then with DeFi is that the regular person has a lot more market access than they would in the traditional Wall Street world, where everything is full of regulations and red tape. Now with the ability to transact with whoever throughout the world borderlessly, everyone could potentially become an investor themselves and be in control of what they're doing themselves. Everyone and people start to have more access. So a lot of the fees and commissions that I guess investment banks would charge as well, which must represent a large percentage of the revenue, not insignificant. All this stuff is threatened as well, I would say, by the whole crypto and DeFi space.
Yeah, absolutely. It's hard to say which things will be disrupted in which order, but the low-hanging fruit, I think, is probably in these retail banking transactions where, assuming the trilemma is solved and we all have access to USDC and a modern crypto wallet, like I can send you $10,000 at a cost of 50 cents, right? So, the slogan for the company Celsius, right? Unbank yourself. I think it's a very clever one, in that you really do become your own bank in that way. And you're getting paid interest directly, right? And it's totally changing how consumer banking will work, I think. And the access and excitement, although retail investors generally, are, of course, and sorry to say this, undereducated compared to the professionals on Wall Street, the ability to take ownership of your own finances, investments, I think also spurs the want for education. And much like how decentralization is providing this opportunity, the internet has provided an opportunity for education around all of this stuff, right? Like there's no excuse anymore if you want to be responsible for your own finances to not be educated. Every resource you could possibly imagine is easily found with literally a few strokes on a keyboard. So I think access to investments in a way that historically has not really been accessible to the individual retail investor will probably become more accessible. And I'm pretty sure there's even new regulatory ideas and legislation coming about such that one could achieve what we call accredited investor status in the United States through an education class, as opposed to the $1 million net worth or $200,000 per year for 3-year threshold that is required to have accredited investor status. And so I think that's a very positive thing, just because people should be able to learn through mistakes, and mistakes will certainly be made, and they've certainly been made in the market as it relates to crypto, right? And people need to learn, what the capital asset pricing model is and where risk is and what rewards are associated with different types of investments. And, we see this all the time in the news now, right? Like, why aren't we educated about finance and economics in elementary school? And it's a very good question, right? In terms of practical skill sets, surviving in the modern world, most people should have this independent knowledge, which to me should be fundamental. But I think that, there's certainly a tension between allowing for this type of retail participation in complex investments and the want for people to explore it for themselves. But I think it's a healthy thing. And I think that trend will continue because of what decentralization has already demonstrated, which is that there's an interest, to say the least.
I think even just the decentralization of information provenance and access of information too. We were talking about this just before getting on to this podcast, just how, well, for us in the field that we're in, how tough it is to keep up to date with different information from different sources. If I'm listening to podcasts or reading books or reading Twitter or reading Substack or dialing into Twitter Spaces to peep in on a conversation, it's just crazy the amount of information that is out there. But it gives people, like you said, the ability to take control of their, I guess, their financial life. And another point you mentioned, like the USDC stuff, I think with the advances in stable coins like USDC or Tether or whatever we want to talk about, it gives the people the ability to even just, I guess, step away from the volatility of just having too much exposure to crypto. If they're looking to have a little more of a balanced portfolio, you literally don't have to re-enter the traditional banking payment rails. You could just step sideways and trade some whatever crypto you're holding, name it, for USDC, and all of a sudden you have this asset class that you basically traditionally would have had sitting in a bank account or sitting somewhere. You don't necessarily need to re-enter the traditional finance world at this point anymore. So as these things continue to evolve, like if I was the CEO of a large, whatever, like a consumer bank or a large investment bank, and I was looking for kind of what is the right strategy for my business to not kind of get totally disrupted by the trends that are happening here, what would be kind of a good strategy for you would recommend to me as the CEO of one of these banks? And I'm not talking about just offering custody services of crypto to consumers, but what would be a good step, or how would you what would you recommend to me as the CEO of a bank?
Yeah, I will preface this with the fact that I'm certainly not qualified to ever run an investment bank, but I would say that there's obvious bubbling populism, right? When we see things like the meme stocks and GameStop and the movie theater and Dogecoin, right? Where people are expressing their dissatisfaction with institutional power, or what they perceive to be institutional power, right? And of course, we can make the argument that corporations are people too, right? And that Wall Street manages assets on behalf of endowments and pensions and mutual funds and all of these things that ultimately an individual has contributed to or has assets in, right? They're just better at it. But in many ways, seeking alpha, right, is a zero-sum game. If you're not just seeking average market returns in a passively allocated portfolio. But I think that banks are already doing what they can given the risk profiles of their investors. And for an endowment with $100 billion under management, for them to do all of the due diligence and compliance work and all of the work required to take a position in something, it has to be a pretty sizable one most of the time. And so the phenomenon of cryptocurrencies in and of themselves is largely focused on the retail investor. And institutions and banks will likely integrate those offerings in a way that risk is I would say, adjusted for, right? But it's still very much a nascent and volatile market. And most investors don't want to withstand that type of volatility. And although, the market has grown considerably, it's still paltry compared to the largest markets in the world, Forex and credit markets, right? And so the liquidity, the volatility, and the risk profile of either buying and holding or trading cryptocurrencies right now doesn't suit the investment profile of most institutions. And will and could that change over time? Certainly. But the reality is most cryptocurrencies, people are probably not going to enjoy me saying this, are a white paper and a wish. And people that haven't been venture investing or working in startups probably don't have an appreciation for that risk. 1 out of 100 companies at seed stage succeed, maybe like 1 to 5, right? If you're good. And so people probably don't appreciate that to the magnitude that they should. And investment banks are certainly aware of that, right? And so I think as things evolve and de-risk, there's certainly opportunity for, public tokens or decentralized tokens to have a place in the world where they are more broadly used. But people have to be aware that there's a lot of value in the Federal Reserve in the United States maintaining the dollar as the world reserve currency, right? And so it's not like they have a vested interest in allowing some new currency that isn't controlled by them to proliferate to a degree beyond their control. So the geopolitical and social phenomena around this space can't be ignored. But banks are limited in what they can offer just from a risk perspective, right? And again, it's very early on, and it's a super volatile asset class that, of course, has promise to some degree as far as assets themselves go. But I think the underlying technology, increasing efficiency, and just allowing for automated transactions through smart contracts and zero knowledge proofs and everything else that are derivative of asymmetric cryptography and DLT networks, that's probably where the real value will come into play.
Right. So
at that scale is just, it's difficult to even begin to quantify.
Yeah. So we're talking about really continuing to focus on gaining more efficiencies through, for example, smart contracts, whether it's my B2B relationships and transactions or my B2C. There's stuff that could be done a lot more smoothly and with a lot less friction, I guess, in the transaction. You also mentioned the meme stock, which that was
AMC.
Yeah, well, there was a bunch of them at the start of the year, like you mentioned, and Dogecoin kind of being in the same bucket there.
Yeah.
It's that was quite an interesting phenomenon. I think that we probably shouldn't overlook. Whereas, like, I really see, I guess, in the evolution of the web, like when the internet first started getting mass adoption, it was more of everyone was more kind of a spectator or a consumer. Basically, you would consume information from there. But as I guess we moved more into Web 2, if we categorize it that way, with more social networks and so forth. Everyone kind of became a creator. So everyone has their blog, everyone's able to contribute. So it's not just a one-way consumption. It's more bi-directional.
Yeah.
In Web3, it's kind of like you're shifting towards, rather than everyone being a creator, everyone actually could be an investor. And I think the power of the mob, or the power of the community, however we want to categorize it, as we saw in these meme stock things, I think it's the tip of the iceberg.
I totally agree. Yeah, the more and look, I think one of the things that got me interested in this space in the first place is that, I had proven to myself time and time again that absolute power corrupts absolutely. And there needs to be accountability and transparency from the top down for people to trust and engage with the system such that they're invested in it and are able to express themselves. And that social element is really what's kind of bubbling to the surface with all this stuff, right? And it can't be ignored anymore because of the advent of the internet and decentralization protocols and Bitcoin and privacy coins and, what's obviously near and dear to our hearts, which is self-sovereign identity and the right to control your credentials and assets, especially in the digital world and hopefully the physical one as well. So I just think that because there's an alternative model now where institutions aren't necessary for many things, it's going to be a very interesting thing to observe when people really understand the consequences and potential of that.
Yeah, and it's crazy because you saw the impact of a community moving in stride together with like these stocks, and it's crazy to think that the power they had there, while there's still being friction in the system, while that they having to coordinate together through Reddit forums or Discord groups or whatever. All of these frictions are starting to be removed, and that's where I think that I did an episode, a couple episodes of the podcast ago on DAOs specifically, and that's where really you could facilitate the coordination of movement and deployment of funds a lot easier than it's done today. And so I really believe that what we're seeing, where everyone is an investor and everyone can make an impact, and you'll have kind of smaller sub communities of people that have the same ideals or want to move in the same direction, are going to be able to do it much more seamlessly than they can even today. And just to say, even today, we're seeing the impact of that on Wall Street when people move together. So I want to shift a little bit. We've been talking about kind of the risks, kind of the better understanding capital markets, better understanding the whole banking sector, and where some of the risks and some of the innovations are happening around there. One topic that is growing in popularity, and a lot of central banks are stepping in that direction, is the whole topic of central bank digital currencies. What are those, and what's your thinking around these?
Yeah, it's a very complex subject. So central bank digital currencies would exist generally in two basic forms, with many potential other forms, I guess you could say. One is a retail central bank digital currency, and the other is a wholesale central bank digital currency. A wholesale central bank digital currency would essentially represent a mechanism to settle large batch transactions between central banks around the world. And there's initiatives through the Bank for International Settlements focused around the innovation hub at the monetary authority of Singapore, and there's a lot of value to be done or created through cooperation in that sense. And then there's retail central bank digital currencies, where an individual can hold a potentially interest-bearing account directly with the central bank as opposed to a commercial bank. And there's many different ways that you can structure a central bank digital currency. The one that I'm most familiar with is the implementation of a retail central bank digital currency and payments platform created in tandem with the National Bank of Cambodia, with the company I previously worked for before Tangem called Sorimitsu. And they did it in an interesting way in that they set up the nodes for validating and processing transactions within the servers at the central bank itself, but people were able to create this digital asset wallet with just a phone number and a smartphone and a mobile wallet application, where they still did KYC with a retail bank in partnering with the central bank. And it enabled them to explore a potential way to offer some privacy in transaction that replicates cash, but also have purview over financial transactions that take place within the kingdom, where it serves a benefit to them because historically about 80% of all of the transactions were done with paper US dollars. And so being reliant on not just US monetary policy, but a form of transaction which is virtually unsurveillable, they have very little control over bad actors and can hardly predict what's happening in their own economy. And so for a country like Cambodia, as is publicly stated by Shea Sarah, the governor of the national bank, I believe is her title, they don't want to be as dependent on the US dollar as they are. And so that was one of the early implementations of a central bank digital currency that's pretty much moved beyond the pilot stage. And then you have another example with the People's Bank of China, which has been in development, I think, for the past 5 years. And large scale pilots where this mobile wallet was distributed to individuals in large cities in large numbers has already happened. And, I think, again, you have to address the kind of the socio-political elements in these things, because none of it happens in a vacuum, and it affects the daily life of people there. I wouldn't say dramatically, but in a way that, although the People's Bank of China is promising to provide transparency and some degree of privacy, the suspicion is that surveillance is the priority, which is understandable when you have a country that large, right? To maintain law and order. And obviously they've proven the value of top-down central planning and economic activity and infrastructure development. It's an interesting phenomenon, right? Because it highlights how different every country's demographics and needs and economic growth engines are. But of course, it highlights the fact that international economics and trade are really the core issue when it comes to how a country deals with its currency and monetary policy and its standing in the world. So there's certainly political, socioeconomic, and very serious implications and obviously unintended consequences that need to be very carefully measured. And pretty much every major jurisdiction in the world with a central bank is doing that exactly now and has been for the past couple of years, which I think was really sparked by Facebook's Libra announcement, which initially, very interestingly, described that token to be composed, I believe it was 50% US dollars and the other 50% divided equally between yen, pound, and euro. And Congress and regulators reacted very swiftly to that because up until the last few years, the US dollar has been the world reserve currency at 67% of foreign central banks' holdings, almost an exact majority, which is obviously an interesting number. And there's tremendous implications to any change in that. So the Federal Reserve is obviously acutely aware of the implications of both other sovereign states rising in economic power, whether they're friends or enemies, I guess you could say, and are obviously also very much aware of what decentralized public currencies with no central governing authority might have, what impact they might have. So whether you want to call it currency wars or, the evolution of the global monetary system, there's a lot of variables that central banks are, debating about. But I think the interesting thing that ties it all together is if people cooperated and had interoperability across borders in all countries, trade would be much more frictionless, right? And I think it's, an economic theory. I forget if it's the law of competitive advantage or comparative advantage. I always forget. But different countries have different resources and different specialties, right? And it stands to reason that the more efficiently you can trade, the more valuable all these parties become, right? So just reducing friction on an international level itself has obvious value. But the cooperation and individual motivations on behalf of each country and bank and jurisdiction vary wildly. But interoperability, I think, is probably the most common.
I'd be interested in just making a comparison here. Just if we assume that there is going to be, I don't know if commercialization is the right word, but central bank digital currencies are going to become a thing in the upcoming years. If we look at how the central bank of the US, for example, does business, they, every now and then they'll reload the printer cartridge and print, I guess it's no longer in the billions, but it seems more common that the supply is in the trillions that just gets added to the US economy or the world economy. So I guess being in the printer cartridge business is maybe not a bad business to be in here, but if we look at the US bank basically prints new supply of cash, what does the supply chain kind of downstream from that look like? Because I'm assuming that if you replace that, like the process today with kind of rather than physically printing cash or they're not physically printing everything, but you're creating the central bank digital currency, it would possibly disintermediate possibly the banks from the downstream supply chain there. And so what is going to be the difference for the banks between the way it's done today and cash gets created and distributed downstream versus if we move to the central bank digital currency?
Yeah, it's a very complex issue, but yeah, I mean, going into the details and depths of fractional reserve banking and credit creation by the Federal Reserve is a difficult subject. But on a high level, when there's systemic shock or black swan event like COVID, right, where the belief is that by making money cheaper to borrow through loosening of monetary policy and cheaper interest rates and increasing the supply and therefore hopefully the velocity of money, you're greasing the wheels of the economy to ensure that consumer confidence is maintained and that the wheels keep spinning, right? And so it's a very difficult task that it looks like the central bank has performed very well. But obviously, everybody is concerned about the consequences, and top of mind, of course, is inflation. So the disintermediation of commercial banks, because you can potentially hold a direct account with a central bank that potentially is interest bearing, is the thing that commercial banks are worried about, as is the central bank, right? Because the commercial banks certainly serve a valuable purpose, right? We alluded to underwriting and credit scoring and all these things earlier, but and also just spreading out risk properly and measuring and maintaining an appropriate risk profile and the reserves that a bank has to hold to prevent runs on the bank and widespread chaos are very much a part of that and are dictated by authorities of government, not banks necessarily themselves. If it's not the central bank, it's very interesting because again, they do have to be concerned, right? Because DeFi allows for people to easily create loans, especially well collateralized ones, right? Where the spread that a bank would make on borrowing money or holding deposits and then lending out to consumers or institutions is somewhat threatened by that. But because of the stability that the financial system now provides, it's very unlikely that the central bank would do much to disrupt that. That said, there are certainly use cases which they're probably thinking about, not just now, but even 10 or 20 years out. But one of them would have been, instead of mailing paper checks to people who they don't even know deserve them for the stimulus checks as a result of COVID, they could have directly given you USDC with the push of a button, knowing exactly who you were, how much money you had, potentially what your tax history was like, if it was recorded in this more modern Web3 infrastructure we're talking about. And so there's certain, and just offering basic services to the unbanked or the financially illiterate, but also being able to replicate cash-like payments with a degree of anonymity that currently really is only provided by paper cash, which Americans love, right? We love our freedom. So those are all possibilities, but I think another one that's on the horizon that will probably be discussed is universal basic income, because with all of the automation that is very, very likely to happen in the near future, there will have to be a transition where people that lose their jobs to automation will have to find new skill sets, new ways of working. And, you know, the utopian perspective on that is that we will be able to use machines and AI to do all of the jobs that, you know, to some degree are inhumane, and be able to reward people with something more fulfilling. So I think that there's a lot of potential there just through automation and efficiencies through it. But when you have reduction of systemic risk through purview of markets that are interconnected and interoperable and measurable, with the potential to preserve privacy on individuals and even institutions' behalves, it's a very interesting recipe that is obviously being explored. But the shape that it takes with respect to central bank digital currency or privately issued stable coins or cryptocurrencies, or just, you know, typical M1 and M2 distributed through commercial banks, it's all a very large guessing game. But, you know, the central bankers are very smart, and they understand that a degree of control is required, because we've all just witnessed how fragile society can be, right? And it's very easy to forget that. But I think it's a very important long list of pros and cons that they're almost all actively reviewing as we speak.
Yeah, so you have these black swan events, like you referred to a couple times in the conversation. So you want to make sure with new infrastructure that I guess I was gonna say you protect yourself from black swan events, but black swan events are black swan events because they're kind of totally, yeah. And you mentioned universal basic income as well. I think we're already seeing a transition in, obviously, like, we're moving further and further away from the industrial age, where it's all about showing up to a specific location between time A and time B and doing specific tasks. I think, like you mentioned, with AI and machine learning, the automation of everything, it's taken away the need to be doing these types of industrial jobs. And we're already seeing that, right? Where they do surveys with children or kids in school of what they want to be when they grow up, and the most popular one is like YouTube influencer now, which is crazy. And so I guess the interesting thing with the central bank digital currency is that you could achieve a lot more efficiencies. I think if you combine the central bank digital currencies with government issued digital ID, which is the direction that governments globally are going in as well. So if you combine those two together, it's kind of like, on the efficiencies metric, it's kind of like a hard check on lowering friction from the whole system. There's a hard check on that. I think the privacy concerns, or the ability to opt out, that's one that kind of could be a real dangerous road really fast if I guess if that's not done right. But then you have other stuff. It's like, will the need for all of the financial compliance costs that are related to KYC and AML disappear? Potentially, if you have traceability in the whole system and it's verifiable traceability, maybe AML disappears completely. But then I don't know, again, like I wonder if there's going to be one system or multiple systems. Like, do you have the ability to opt out? Like, it's kind of a futurist question because we really have no clue. But these are the types of things that as people, and you said as Americans like their freedom, that's the type of thing that if you want to be off the radar, it's kind of it should be a right of yours.
Yeah, for sure. And, we still have major issues like conservatively estimated $1.2 trillion of money laundered every year, I believe is the stat. Tax evasion, of course. And you're seeing, a very interesting reaction to that now with a global minimum corporate tax. And, a favorite quote of mine is sunlight is the best disinfectant. And so I'm actually much more a proponent of transparency, because if you're doing nothing wrong, you shouldn't have much to hide. And so,
which is true on both sides, because I could also look on the government side of things and saying maybe more transparency from their part is going to bring greater accountability as well.
Absolutely. Transparency breeds accountability. And I think that, one of my favorite money managers and authors is Ray Dalio, and he wrote a book called Principles. And in it, this, the first couple of principles are, one, you have to aggressively confront your reality, and in a group be radically candid. And that candor and transparency and adherence to truth allows you to solve these more difficult problems more quickly, right? And if those things aren't brought to the surface, whether through, the avarice of man or just because people are afraid to talk about it, they will linger and cause more problems. So as far as I'm concerned, transparency from an institutional level is a very difficult thing to figure out, right? Because we still have nation states with guns and specific interests, and we're not always going to agree on how things should be, right? So there's a natural layer of deception involved just for those simple reasons. And so it's a very difficult trade-off that leaders of institutions today have to figure out. And I think that the internet and decentralization offer the opportunity to create transparency and trust, but it has to be done in a very measured and careful way. And I think the United States actually does a pretty good job of watching and waiting and learning before committing to regulation. And I think, digital asset regulation and central bank digital currency initiatives aren't an exception. So that said, there's, these smaller countries that are moving very nimbly. Estonia being an example. I mean, Canada, not so small, but obviously super progressive when it comes to digital identity frameworks and, progressive adaptations of this technology. So time will tell, but I think that's the transparency and accountability that it breeds are a huge opportunity that global leaders need to really think hard about.
Thanks for tuning in today. Hope you enjoyed the conversation as much as I did. To stay up to speed with future episodes, or to catch up on ones you may have missed, make sure to check out the SSI Orbit podcast on your favorite podcast platform, and make sure you subscribe. If you have any questions, comments, or wish to see someone in particular on a future episode, you can find me by searching Mathieu Glaude on LinkedIn or Twitter. Feel free to reach out to me directly and I'll get back to you. See you all next time.